Welcome to today's deep dive. So, I want you to imagine for a second that you're sitting down at a high stakes poker table.
Okay, setting the scene.
Right. And, you've got your chips, you've memorized a few strategies you found online, and you feel pretty good about your hand.
As one does.
Yeah, exactly. But what you don't realize is that the house has this giant two-way mirror right behind your back.
Oh, man.
And it gets worse. The dealer is actively counting cards, and the other players at the table, well, they're wearing earpieces and sharing probabilities in real time.
So you're basically the mark.
You are 100% the mark. You think you're playing a fair game of poker, but in reality, you're just, being managed. And that is the U.S. stock market for the everyday investor right now.
It's a brutal analogy, but it's pretty accurate.
It is. Wall Street has always worked for Wall Street. But today we're unpacking this massive shift in how everyday people like you can access financial data.
Yeah, we're looking at this really crazy collision between these, frankly, terrifying market highs and advanced AI.
Right, an AI that's effectively dismantling a century-old information monopoly.
Because it really is a monopoly, right? Like, it thrives in obscurity. For decades, the financial industry hasn't necessarily hidden the data from the public.
They just made it impossible to read.
Exactly. They buried it under so much friction and legal jargon and, exorbitant paywalls that it became virtually inaccessible unless you managed a $1 billion fund.
Which brings us to the mission of today's deep dive. We are pulling back the curtain on a stack of fascinating sources today.
Really fascinating stuff, yeah.
We've got this detailed documentation on an AI-native investing platform called deepvalues.ai, and we're pairing that with some current macroeconomic metrics that should, frankly, have everyone paying very close attention.
It's a very timely combination.
It really is. Now, before we get into the mechanics of this, I have to do a little legal housekeeping, which is, ironically, exactly the kind of boilerplate we're going to talk about AI reading for us later.
Right, the fine print.
Yeah, the fine print. So, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice.
Very important.
Yep, you must conduct your own due diligence before making investment or financial decisions. And hey, while I'm doing the obligatory host things, don't forget to like this video. Much appreciated.
It's a necessary disclaimer, but it actually ties perfectly into the ethos of the tools we're discussing today.
How so?
Well, due diligence is the entire ballgame. That's
Yeah.
what we're talking about, giving you the tools to actually do the diligence.
It is, and by the time we wrap up today, you'll know exactly how to access advanced research and multi-agent AI by joining the deepvalues.ai community and how to track the market's temperature using the Buffett Indicator iOS app.
Which is going to be crucial.
Absolutely. So, let's get right into it. Let's talk about that casino where one side is counting cards.
Right, the information asymmetry.
Yeah, the sources point out that for roughly 100 years, institutional investors have had this massive structural advantage. Let's frame this with the actual dollar cost of entry.
The baseline cost, just to look at the same screen as the professionals, is staggering.
Mhm.
A single Bloomberg terminal seat.
Which is basically just a fancy keyboard and a monitor, right?
Well, it's the industry standard for real-time financial data, but yeah, it's a specialized setup. And that one seat costs roughly $25,000 a year.
Wow.
And that's just for one user license.
25 grand a year just for the data feed.
A very fast data feed, but yes. And honestly, that is merely the cover charge to get into the club.
Right.
If you look at the operations of a standard hedge fund, the research desks cost upwards of $50,000 annually per analyst at a minimum.
Just to have them sitting there.
Exactly. That capital goes toward maintaining proprietary data feeds, massive server farms for quantitative analytics, and, complex financial models.
It's an arms race.
It is. These teams are mobilized to read every single Securities and Exchange Commission filing, every 10K, every 10Q, the absolute millisecond it drops into the public domain.
So when a company reports their earnings at 4:00 p.m. by 4:001 second, the algorithms have already scanned it. And by 4:05 p.m., an analyst making $500,000 a year has already modeled out the cash flows for the next decade.
That's exactly how it works.
Meanwhile, what is the regular retail investor doing? We're sitting on our commute waiting for a late headline from a free financial news site.
Or worse.
Right? We're scrolling through some social media influencers' hot take.
Yeah.
We're operating on a prayer, trading against a supercomputer.
Which is why this concept of information asymmetry is the foundational pillar of modern finance.
It's not just a small advantage.
No, it isn't just a slight marginal edge. It fundamentally dictates the flow of wealth. The market is basically a mechanism for transferring money from the uninformed to the informed.
That's a harsh way to put it, but it's true.
It's the reality. The entities that possess the data first, and more importantly, possess the infrastructure to instantly synthesize what that data means, they are the ones who position themselves to profit.
Right.
When a retail investor places a market order on their smartphone app, they are almost always taking the other side of a trade from an institution that holds vastly more intelligence on that specific asset.
But I can hear the pushback from the audience right now because on paper, hasn't the internet already democratized this?
What do you mean?
Well, in 1985, sure, you had to call a broker to get a stock quote. But today, I can go to Yahoo Finance, I can look up Apple's balance sheet, I can download their 200-page annual report for free as a PDF. The data is out there, isn't it?
That is the great illusion of the digital age. We constantly confuse access to raw data with access to synthesized intelligence.
Synthesized intelligence. Okay, unpack that.
Think of it like this. Having a library card to the Library of Congress doesn't make you a constitutional scholar.
Oh, that's a good analogy.
Right. Yes, the internet allows you to download a 200-page 10K document. But Wall Street's $50,000 infrastructure parses that 200-page document and extracts the specific material change in a supply chain contract that's buried in footnote 14 on page 108.
The needle in the haystack.
Exactly. It gives them the exact 3 bullet points that actually move the stock price, and it does it in 3 seconds.
So it's not about who has the document, it's about who has the synthesis of that document.
Yes. The average person simply doesn't have the hours in the day to distill a 200-page legal document written in dense accounting terminology into a cohesive financial thesis.
No one has time for that. You have a job, you have kids.
Precisely. That gap, the chasm between raw, unstructured data and actionable, mathematically sound intelligence, is what Wall Street monetizes.
Right.
And it is exactly what this new wave of multi-agent AI is designed to close.
Okay, so knowing that this AI tool exists is one thing, but timing is everything in finance. Why is this tool arriving right now, and why is it so desperately needed by the average investor today?
The timing is a really critical piece of this puzzle.
Because the sources pivot right to the macro environment here. When you zoom out and look at the whole picture, the current market metrics are flashing some serious warning signs, right?
Yeah, they are.
Mm.
The sources highlight a precarious historical collision.
Okay.
We have artificial intelligence finally reaching a threshold where it can read, reason, and synthesize financial documents at the level of a top-tier human analyst.
Which is amazing.
It is, but this capability is arriving at the exact moment the broader market has become dangerously stretched.
Stretched might be putting it mildly, from what I'm reading here.
Sure.
The documentation leans heavily on something called the Buffett indicator, which is famously Warren Buffett's preferred macro gauge to determine if the entire stock market is overheated.
And what's it at right now?
Right now, this indicator is sitting at a staggering 231%.
Wow. A number that should command the respect of any market participant.
For those who aren't familiar, let's unpack the mechanics of that gauge. What exactly goes into the Buffett indicator?
It's remarkably simple, but profoundly revealing. It is just a ratio. You take the total market capitalization.
Meaning the combined dollar value of every single publicly traded stock in the U.S.
Correct. You take that massive number and you divide it by the gross domestic product, or GDP, of the entire country.
So it's comparing the price tag of the stock market to the actual economic output of the real world, like people buying cars, building houses, selling software.
Exactly. The real, tangible economy. And a reading of 231% means the U.S. stock market is currently priced at roughly 2.3 times the size of the entire U.S. economy.
That's just wild.
On the historical gauge, this literally registers as significantly overvalued.
Just conceptually, that feels unsustainable. The stock market is supposed to be a reflection of the economy, right? Not double the size of it.
That is exactly Buffett's rationale. Over the long run, corporate profits are simply a slice of the overall economic pie.
Right.
The stock market cannot perpetually outgrow the underlying economic engine that generates those profits.
It defies physics, or at least economic physics.
Yeah. When market valuations detach this severely from economic reality, it means investors are pricing in decades of flawless, uninterrupted future growth.
And nothing is flawless for decades.
No. And history shows us that gravity eventually takes over.
Let's look at that history, because if I'm a listener, I'm thinking, well, the market always goes up eventually. I'll just ride it out.
Right, the stocks always go up mentality.
Exactly. But the sources bring up another metric that pairs with this 231% number, the Shiller PE ratio, which is currently sitting near 40.
Ah, the Shiller PE, or the cyclically adjusted price-to-earnings ratio.
Okay, break that down for us.
This was developed by Nobel laureate Robert Shiller. Instead of just looking at a company's earnings from last year, which, might be artificially high due to a temporary economic boom.
Like a post-pandemic spending spree or something.
Right. Instead of that, the Shiller PE looks at corporate earnings over a 10-year period, and it adjusts those earnings for inflation.
Oh, so it smooths out the business cycle?
Exactly. It gives you a much truer picture of what you are actually paying for $1 of corporate earnings.
And hitting a Shiller PE of 40 is that high.
It is incredibly rare territory. If you look back over the last century, we only see this metric climb to these heights around generation-defining market peaks.
Like when?
For instance, the late 1920s, right before the Great Depression,
Oh, wow.
and the crescendo of the dot-com bubble in 1999 and 2000.
So really bad times to be heavily invested in overpriced stocks. Let's talk about what happens after those peaks. Because the sources mention the risk of lost decades.
Yes, lost decades.
For an everyday investor, what does a lost decade actually feel like? Because it sounds terrible.
It is psychological torture for an investor, honestly. A lost decade means you invest your capital at the peak, the market crashes, and then it takes 10, 12, or sometimes 15 years just for your portfolio to break even.
15 years just to get back to zero.
Exactly. Think about the dot-com bubble. The NASDAQ Q Composite hit a high in March 2000. It crashed, and it did not reach that same numerical high again until 2015.
So if you put money in at the top, you were just underwater for a decade and a half.
That is a 15-year period where buy-and-hold investors saw zero nominal price appreciation.
That completely breaks the traditional retirement math people rely on. If you're counting on 8% a year and you get 0% for 15 years, your retirement is gone.
It is, which is why understanding this macro environment is so crucial right now.
Right.
When valuations reach the extremes we are seeing today, the institutional smart money is already acutely aware of the historical precedents.
Because they have the analysts, they have the data.
Yes, they position themselves for the fallout. They start hedging their portfolios, moving capital to cash or fixed income, while retail investors,
And we're still buying.
yeah, they're often still aggressively buying, driven by the fear of missing out.
The FOMO is real. So for the regular investor tuning in, the most valuable asset you can possess in a 231% market isn't a hot stock tip from your buddy.
No, absolutely not.
It is situational awareness. You have to
Yeah.
know the temperature of the room before you decide how many chips you want to push to the center of the table.
Awareness is your primary risk management tool.
And what I find brilliant about the sources we are looking at is that they don't just point out this massive problem, they give you a direct way to monitor it.
Right, the app.
Yeah, the documentation explicitly notes that you can track this exact cycle level signal right from your phone. To track the total market temperature, I highly recommend you welcome to search and download the iOS app Buffett Indicator from the Apple App Store or look for Bubble Watch on Android.
It literally puts this macro gauge on your home screen.
Having that data point passively updated in your pocket is a massive shift, isn't it?
It really is. You are no longer waiting for some financial pundit on a cable news show to write a quarterly newsletter telling you the market is expensive.
You just look at your phone.
You have the real-time mathematical ratio yourself. It anchors your perspective and keeps you grounded.
Okay, so we've established the battlefield. The market is incredibly expensive, the risks of a lost decade are highly elevated, and Wall Street holds a $25,000 a seat monopoly on the data needed to navigate it safely.
Not a great setup for the little guy.
No. So how does the average person fight back? This brings us to the core engine outlined in the dossier, Deep Value Intelligence, or DVI. Let's unpack the brain of this operation.
DeepValues.ai is powered by this DVI engine, and the best way to conceptualize it is as a tireless senior financial analyst.
Like an analyst that never sleeps, doesn't drink coffee, just reads.
Exactly. Its primary function is to systematically ingest and process the massive fire hose of regulatory disclosures.
We're talking about the SEC filings, right?
Right. The filings companies are legally required to submit. The 10K annual reports, the 10Q quarterly reports, 8K current reports outlining material events, and proxy statements.
The really dry, dense stuff.
The driest. And it doesn't stop there. The sources say it's also pulling earnings call transcripts, 13F institutional holdings, and Form 4 insider trades.
It's digesting thousands of pages of dense financial legal speak per company.
Per company, yes.
But what I want to zero in on is the output. Because it isn't just regurgitating a massive spreadsheet, which wouldn't help me much anyway. It writes plain English research briefings.
That is the synthesis we discussed earlier. It takes a 200-page document.
Which, again, no normal person has time to read.
And it extracts the narrative. It clearly articulates what the company actually does, the specific mechanics of how it generates revenue, the prevailing risks to its business model, and a theoretical framework for its worth.
That sounds incredible, but wait, I have to play the skeptic here.
Please do.
Anyone who has used a standard AI chatbot over the last year, they have a tendency to, Lie.
Hallucinations.
Yeah, hallucinations. If an AI doesn't know a company's revenue in Q3, sometimes it just invents a very convincing, authoritative sounding number.
Which is dangerous.
Exactly. In finance, a hallucinated number isn't just a funny quirk where it gives you a weird recipe for muffins. It literally destroys your portfolio.
And that is the fatal flaw of using generalized large language models for investing. If you just ask a normal chatbot for financial advice, you're playing with fire.
Right.
But DVI is built differently. The crucial differentiator here is that it shows its work. It operates on a principle of grounding.
Grounding. What does that mean in this context?
It means every single conclusion, every metric, every risk factor the AI surfaces in its briefing is hyperlinked back to the specific source filing.
So it's not generating opinions out of thin air. It's acting as a retrieval and synthesis engine.
Exactly. The transparency is paramount here. You aren't being asked to blindly trust the AI.
Right.
You are using the AI to locate the needle in the haystack. Once it finds the needle, say, a really concerning clause about debt restructuring, it hands you the original SEC document with that specific paragraph highlighted.
So you can verify the context yourself.
Yes. This automates the grueling grunt work, allowing the user to skip the legal boilerplate and immediately focus their human intuition on the core thesis.
That is a massive paradigm shift. Just skipping to the part that matters. But, let's look at the reality of the retail investor. I'm a busy professional. I have a commute. I have family obligations.
You don't want to read a 10K.
Even if the AI highlights the most important parts of a 10K, I am probably not going to sit down on my couch at 8:00 p.m. on a Tuesday and read a textual financial brief on my phone. The friction is still a bit high for everyday life.
Well, the creators of the platform seem to have anticipated that exact behavioral hurdle.
Really?
Yeah, the sources detail that DVI goes a step further by using multimodal generation. It actually creates video and audio versions of its research.
Okay, this is where it gets really cool. You're saying you can open the app, pick a stock, and literally hit play to watch or listen to a mini documentary about that company's financials while you're driving to work.
That's exactly what it does.
That takes institutional-grade analysis and packages it with the accessibility of, like, a true crime podcast.
It dramatically lowers the barrier to entry for continuous learning. You can learn about a company's cash flow while washing the dishes.
That's wild. So we understand the brain now, this DVI engine. Now I want to look at what happens when we apply this AI to the actual market. The sources break this down into specific pillars, and pillar 1 is the holy grail of investing, computing intrinsic value.
Intrinsic value, the bedrock of fundamental analysis.
So what is it exactly?
It seeks to answer the ultimate question. What is a company actually worth, independent of what it currently trades for on the stock exchange?
Because price and value are not the same thing, right?
Not at all. People confuse them constantly. The price you see flashing green or red on your brokerage screen is simply the intersection of supply and demand at that specific second.
Just what someone is willing to pay.
Right. It is what a willing buyer and a willing seller agreed upon. It is heavily influenced by emotion, news cycles, momentum, and hype.
Like when a meme stock shoots up 300% in a day.
Exactly. Intrinsic value, on the other hand, is the cold mathematical reality of the underlying business.
To figure out that cold reality, the documentation says Deep Values runs discounted cash flow, or DCF, valuations nightly across thousands of companies.
Nightly. That's a lot of compute.
Yeah, and it uses 3 different methods to create a fair value range, setting conservative, base, and optimistic bounds. But for the listener who maybe didn't, suffer through an MBA program, how does a DCF actually work? Walk me through the mechanics without the Wall Street jargon.
Okay, let's use a very grounded example. Imagine you are looking to buy a local laundromat in your neighborhood.
A laundromat. Okay, I'm with you.
How do you decide what that laundromat is worth? You wouldn't just look at how much the brick building costs or the price of the wash machines. You would look at the cash it generates month over month.
Right, the profits.
Let's say this laundromat consistently produces $10,000 a year in pure free cash flow. That's money you can put in your pocket after all expenses, utilities, and machine maintenance are paid.
Okay, $10,000 a year, clear.
If you expect the laundromat to stay in business and stay relevant for the next 10 years, you might say, well, 10 years times $10,000 is $100,000, so I'll pay $100,000 for it.
Seems logical.
But there's a catch. A dollar you receive 10 years from now is not worth the same as a dollar in your hand today.
Because of inflation?
Because of inflation, yes, but also because of opportunity cost. You could have invested that $100,000 somewhere else, like in government bonds, and earned a guaranteed return over those 10 years.
Oh, right. So future money is less valuable than present money.
Precisely. So you have to discount those future $10,000 cash flows back to their present value.
Okay.
The cash you get in year 1 is worth close to $10,000. But the cash you get in year 10, when you factor in that discount rate, might only be worth $6,000 in today's terms.
Got it.
When you add all those discounted future cash flows together, that final number is the intrinsic value of the business.
So a DCF is basically just projecting a company's future cash and mathematically discounting it back to today to see what it's worth right now.
That is the essence of it. Now, apply that same logic to Apple or Microsoft.
A slightly bigger laundromat.
Just slightly. The math gets much more complex. Obviously, you have to estimate varied growth rates, terminal value, and a weighted average cost of capital.
Sure.
But the core philosophy is identical. A company is only worth the discounted sum of the cash it can produce over its lifetime.
And the platform is calculating these DCF models nightly for thousands of stocks. That leads us directly to the concept of a margin of safety.
Yes, margin of safety.
Right.
This is the cornerstone of value investing. It was pioneered by Benjamin Graham, who was famously Warren Buffett's mentor.
How does it tie into the DCF?
Once you calculate the intrinsic value,
Yeah.
let's say your DCF model tells you a stock is mathematically worth $100 a share. You do not buy it for $100.
Why not? If it's worth 100, isn't 100 a fair price?
Because if your growth estimates are off by even a little bit or the economy tanks, you lose money. You have no buffer. You demand a discount. You wait until the market is panicking over some short-term news, and that $100 stock is trading at $70.
So you buy it on sale.
Yes. That $30 gap is your margin of safety. It absorbs human error, unforeseen economic shocks, or just a bad quarter.
And historically, calculating a reliable margin of safety for a watch list of, say, 50 companies required maintaining massive, tedious Excel spreadsheets.
It was a full-time job. You were basically a junior analyst at that point.
To make this incredibly concrete for the listener, the sources use NVIDIA as an example.
Perfect example.
NVIDIA has been on an absolute tear recently, driven by the whole AI boom. As a retail investor, you open your brokerage app, you see the chart going parabolic just up and to the right, and your brain floods with FOMO, the fear of missing out.
Emotion completely takes over.
You think, I have to buy this now or I'll miss the revolution.
Yep.
But imagine instead opening Deep Values. You look at NVIDIA, and right there on the screen, overlaid on the price chart, is the fair value band calculated by the DCF.
The conservative to optimistic range.
Exactly. You can visually see the current stock price hovering way, way above the optimistic intrinsic value line. In 1 second, you instantly know exactly how much pure optimism and hype is already priced into the stock.
It fundamentally rewires your psychological relationship with the market.
It takes the emotion out of it.
Completely. You transition from reacting to price momentum to analyzing structural value. It cools that emotional response.
And again, touching on the transparency we talked about, the AI shows you exactly how it arrived at that fair value, right?
Yes. The assumptions it made about NVIDIA's future revenue growth are one tap away. If you think the AI is underestimating the growth of data centers, you can literally adjust the model.
You are in the driver's seat.
You're not blindly following a machine. You're using it to augment your own thesis.
Okay, so computing intrinsic value gives us the hard mathematical reality of the business. But investing isn't just about math, unfortunately. It's about capital flows and human behavior.
It is.
Knowing what the legendary investors are doing with their billions is a massive piece of the puzzle. How does this platform track the smart money? Because this is pillar 2 in our sources.
This is where the platform leverages its ability to process public filings in real time to cut through the noise.
We're not talking about tracking rumors on Twitter or sentiment on Reddit.
No, or what some analysts said on TV. We are talking about tracking legally binding disclosures.
The actual receipts.
The receipts. First, it tracks the legends. The platform monitors what are called 13F filings for over 60 super investors.
I'm looking at this 13F requirement. These are mandatory quarterly reports filed by institutional investment managers who control over $100 million in qualifying assets.
Big money.
Yeah, so we aren't tracking day traders, we are tracking the whales. Warren Buffett, Ray Dalio, the massive hedge funds.
And you have to understand, these funds go to great lengths to try and obscure their moves.
Why? Why don't they want people to know?
They don't want the market front-running their trades.
Right.
If Warren Buffett is buying a stock and everyone finds out, the price shoots up before he's finished buying all the shares he wants.
Ah, that makes sense.
So they have up to 45 days after the end of a quarter to file their 13F. So by the time the public sees it, the data is already somewhat delayed.
But the moment that filing does hit the SEC database,
Deep Values digests it instantly. It translates the raw, messy data tables into a simple, plain English notification. It tells you exactly what the fund is adding to, what they are trimming, and what positions they are exiting. pushes the intelligence directly to you. But the tracking extends beyond just hedge fund managers. The sources note a fascinating feature. It also tracks the trades of the U.S. Congress.
Oh, this is a huge topic right now. It's all over the news.
It is.
Members of Congress are privy to classified briefings, regulatory shifts, and massive government contract decisions way before the public is.
They have the ultimate information asymmetry.
Right. And by law, under the Stock-K Act, they're required to disclose their trades. Nancy Pelosi's portfolio, for instance, is watched like a hawk. But if it's public law, why is it so hard for the average person to track this themselves without a tool like this?
Because the system is designed with intentional friction.
Go on.
The legal requirement is transparency, right? But the delivery mechanism is total obfuscation. Members of Congress frequently submit their disclosures as scanned, handwritten, low-resolution PDF documents.
You're kidding, handwritten.
Yes. They write it in chicken scratch, scan it on some 1998 fax machine, and upload it as a tilted image file so that traditional databases can't read the text.
That's brilliant in a very cynical, frustrating way. Plausible deniability disguised as technical incompetence.
Exactly. It prevents automated parsing, or at least it used to.
Enter AI.
Enter AI. This is where the computer vision application is truly impressive. Deep Values uses advanced optical character recognition, or OCR, paired with AI vision models.
Okay.
It literally reads the messy handwriting, extracts the ticker symbols, the dates, and the trade amounts from those tilted PDFs, and digitizes the data daily.
It's taking the friction out of the transparency. It's forcing the door open.
It really is.
And that leads us to the third group of smart money tracked in Pillar 2, corporate insiders.
Tracking Form 4 filings.
Well, what's a Form 4?
A Form 4 is a document that must be filed with the SEC whenever a company executive, director, or a major shareholder buys or sells shares in their own company.
Now, if I see the CEO of a company selling $1 million worth of their stock, my immediate instinct is panic. They're jumping ship.
It's a natural reaction.
But the sources suggest the buying and selling dynamics of insiders are actually quite nuanced. Why do we care more about insider buys than insider sells?
It comes down to the hierarchy of market signals. As the legendary fund manager Peter Lynch famously said, insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will go up.
Oh, that's a great quote.
It's very true. An executive might sell stock to buy a new house, to pay for their children's college tuition, or simply to diversify their wealth for tax purposes. A sale doesn't inherently mean the underlying business is failing.
Right, they have lives and expenses just like anyone else. But buying.
Buying is different. When a CFO takes their own hard-earned after-tax cash and buys shares on the open market, it is widely considered one of the most reliable, bullish signals in finance.
Because they know the real numbers.
Exactly. These are the individuals who see the internal corporate dashboards every morning. They know the supply chain metrics, the upcoming product launches, and the quarterly sales figures long before they are released to the public.
So if a stock drops 20% on bad news, but the CEO immediately buys $500,000 worth of shares, that is a massive signal that the drop is an overreaction.
It is the ultimate vote of confidence. And again, the issue historically wasn't that Form 4s were secret, it was the friction of finding them.
Yeah.
Have you ever tried navigating the SEC's EDJR database?
I have, actually. It is remarkably clunky. It feels like a website built in 1995 that actively hates its users.
It's terrible. You have to know the specific company, search the specific form type, and manually read through the HTML.
But this new system flips that dynamic entirely.
It does. You set up a watch list of companies you care about, and the system monitors the SEC database 204/7. The moment an insider buys or a hedge fund enters a position, it pushes an alert to your device.
Okay, so we've covered the intrinsic value math, and we've covered tracking the whales, Congress, and insiders. But investing is deeply personal.
Very true.
Sometimes you don't just want an alert, you have a very specific qualitative question about a company's strategy. This brings us to what the sources call Pillar 4 and the flywheel, Buffylands and the visual ecosystem.
Buffylands is the conversational AI layer that sits on top of all this synthesized data. It allows the user to interact with the financial models using natural language.
So it's like chatting with the analyst we talked about earlier.
Exactly. You can type, or you can literally speak to it.
The sources give a great example here. You can ask it complex valuation questions like, is NVIDIA overvalued based on historical multiples?
Which is a great analytical question.
But you can also ask it to translate the complexity. You can say, explain Berkshire Hathaway's revenue to me like I'm 12.
And that like I'm 12 prompt is crucial.
Why?
Because the financial industry relies heavily on intentional jargon. Jargon is used as a gatekeeping mechanism to make retail investors feel uneducated, encouraging them to just give up and hand their money over to wealth managers who charge a 2% fee.
So they use big words to justify their fees.
Basically, yes. The AI strips away the jargon and explains the core business mechanics in plain English.
And how does it handle a beast like Berkshire Hathaway? Because Berkshire isn't just one company. It's a massive $371 billion conglomerate that owns everything from insurance to railroads.
It's a spider web of companies.
Exactly.
Well, beyond just generating text, the platform utilizes advanced data visualization. For a complex conglomerate like Berkshire, it maps out the empire using visual flow diagrams like Sankey diagrams or detailed donut charts.
Okay, visual learning.
Right, it visually splits that massive revenue stream into its core segments. Geico Insurance, the BNSF Railroad, Berkshire Hathaway Energy, even the Pilot Flying J truck stop.
So instead of reading a dry spreadsheet of revenue segments, you instantly see the plumbing of the business. You see exactly where the cash comes from and how big each slice is.
Visualizing data accelerates comprehension dramatically.
This all sounds amazing for analyzing the outside world, right? Analyzing companies, insiders, the macroeconomy, but how does this platform help the user look inward?
Look inward.
Yeah, how do they actually become a better investor over time? The sources highlight a feature called the investment journal.
Ah, yes. This might actually be the most powerful psychological tool built into the platform.
Really? More than the DCF models?
I think so, because investing is so psychological. The mechanics of the journal are simple. When you execute a trade and buy a stock, you open the journal and capture your specific thesis.
You write down why you bought it.
Exactly. You write down, I bought this company at $180 a share because I believe their new software division will increase margins by 5% over the next 2 years.
The AI then anchors that specific note to the stock's price on that exact date.
Yes.
You know, I actually do something similar in a physical notebook.
Yeah.
What makes the AI integration so special?
It addresses one of the most destructive cognitive flaws in retail investing: hindsight bias.
Oh, this is the Daniel Kahneman stuff. Our brains tricking us into thinking we knew the outcome all along. Like, I knew that stock was going to crash.
Exactly. When an investment goes well, we convince ourselves we are financial geniuses who predicted the future perfectly.
And when it goes poorly?
When an investment goes poorly, we blame unpredictable macroeconomic conditions or the Fed or bad luck. Our brains literally rewrite our memories to protect our egos.
Which means we never actually learn from our mistakes. We falsely attribute luck to skill.
Precisely. The AI Investment Journal removes the ego from the equation entirely.
How does it do that?
Months or years later, the AI can re-examine your original thesis, look at what actually happened to the company's fundamentals, and brutally honestly score how your reasoning aged.
It grades your homework.
It forces intellectual honesty. It will analyze your trade and tell you your thesis about the software division was completely wrong. The margins actually shrank. However, the stock went up because the Federal Reserve unexpectedly cut interest rates. You got lucky.
Yeah.
Or conversely, it might say, your fundamental thesis was entirely correct, but your timing was early and you panic sold the bottom.
That is brutal. Nobody likes being told they just got lucky or that they panicked.
No, they don't. But if you actually want to compound wealth over a lifetime, that objective feedback loop is absolutely necessary. Building a genuine, replicable track record requires unvarnished feedback.
That makes a lot of sense. Another aspect of the platform that the sources emphasize is its global reach. This isn't just a tool built for Wall Street analysts in New York, and it isn't even just for English speakers.
No, the democratization of data is a global mission for them. The platform ships in over 20 languages: English, Chinese, Spanish, Hindi, Japanese, French, Arabic, and so on.
It breaks down not just the financial barrier, but the linguistic barrier to institutional-grade research.
And it breaks down the educational barrier, too. Every single financial metric in the app, whether it's the PE ratio, free cash flow, or return on invested capital, has a tap-to-learn explainer built right in.
There are no dead ends where you just have to guess what an acronym means.
Right. It is designed to be an educational ecosystem as much as an analytical tool.
Okay, I need to step in here. I'm looking at my notes, and I am putting myself in the shoes of the skeptical listener.
Let's hear it.
We have talked about real-time regulatory synthesis, nightly DCF models, insider tracking, OCR parsing of handwritten congressional trades, and AI-driven psychological journaling.
It's a lot.
It sounds like an absolute utopia for an investor. But my alarm bells are ringing. What is the catch?
There's always a catch.
Right. The sources instruct us to address the skeptic, so let's do it. If this platform is genuinely giving away the equivalent of a $25,000 Bloomberg terminal or a $50,000 research desk, why are they giving it away for free?
It's the absolute right question to ask.
We all know the tech adage. If the product is free, you are the product.
Yeah.
Are they selling our trading data to high-frequency trading firms? Because that's what a lot of free brokerages do.
Skepticism is a very healthy trait for any investor. but the documentation is very clear on their business model.
Okay, let's hear it.
The core research experience, the intrinsic value DCF calculations, the macro data like the Buffett indicator, the smart money tracking is 100% free for the user. $0.
So how do they pay for the servers? AI compute isn't cheap. I mean, running large language models costs real money.
It does. They operate on a freemium model based on advanced compute power, not data brokering.
Explain the difference.
The fundamental data and standard analysis are free. However, if a user wants to execute massive, custom AI research runs, say, tasking the AI to read the last 10 years of earnings transcripts for 20 different companies and generate a comparative thesis on their supply chain vulnerabilities.
Which takes a lot of processing power.
A ton of processing power. Those power features require optional paid credits.
So the heavy lifting costs money, but the foundational intelligence is free.
Exactly. And the sources explicitly state they do not operate on an advertising model, and they do not sell your personal data or your trade history.
Okay, but let's dig into why they give the core intrinsic value models away for free. Giving away the DCF models is basically a philosophical stance against information asymmetry, right?
Yes. Wall Street relies on keeping those valuation models behind a paywall to maintain their edge. By open sourcing the fundamental math to the public, Deep Values is actively attempting to level the playing field.
They are essentially commoditizing Wall Street's core product.
They are.
That brings me to my next point of skepticism, though. Trust. You are the calm voice of reason here, so let me grill you on this for a second.
Go for it.
We already talked about AI hallucinations. Even with grounding, AI can make weird logic leaps. How can we trust a machine telling us a stock is undervalued by 30%? Like, what if it just parsed a comma wrong in the 10K?
The platform's core philosophy addresses this directly. Verify, don't trust.
Verify, don't trust.
You should absolutely never trust an AI blindly when it comes to your capital. The platform is designed as a glass box, not a black box.
Explain the difference between those two.
A black box is an algorithm that spits out a price target, like $150. But it completely refuses to tell you how it got there. You just have to trust the machine's magic math.
Right.
A glass box exposes the math. Because the discounted cash flow models on this platform are open for inspection, you retain total critical oversight. You can trace the AI's logic step by step.
So if the AI assumes a company will grow its revenue by 10% a year for the next 5 years, you can see that specific input.
Yes, it's right there in front of you.
And if I disagree with it, if I think the macro economy is slowing down and they'll only grow at 5%.
You literally tap the number, change it to 5%, and the model instantly recalculates the intrinsic value based on your human intuition.
Oh, wow.
The AI is doing the heavy lifting of building the spreadsheet framework and pulling the historical data, but you remain the portfolio manager.
That's a great way to put it. And as we mentioned earlier, because every qualitative claim cites the specific SEC document, you can always go straight to the source to check its work.
That transparency is the bridge between a neat tech gimmick and a legitimate institutional-grade research tool. It empowers the user rather than replacing them.
Exactly.
And it's crucial to reiterate their compliance stance here, too. Deep Values is an information layer designed for education and research. It is not a registered broker.
Right. It's not a financial advisor.
No. It is not going to send you push notifications telling you what to buy or sell. It provides the mathematical framework and the regulatory synthesis. The decision-making always rests with you.
This has been a truly incredible unpacking of a dense but vitally important topic. We've journeyed from the structural monopolies of Wall Street to the macro warning signs flashing in the economy today, and finally to the technological solutions available to the everyday person.
We covered a lot of ground today.
We did. Bringing all of this together, how does the listener actually take action today? How do they bridge this information gap for themselves before the next market cycle hits?
Well, action is the only way to apply intelligence. The tools are available. It just requires a shift in how you approach your research.
Exactly. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community.
Because everything is right there.
We've spent the last hour talking about the sheer volume of capabilities now available for zero cost. The intrinsic value calculations, the smart money tracker, the AI investment journal, the regulatory synthesis, it is all sitting right there waiting for you.
It represents a profound shift in market access. But as we discussed, keeping an eye on the macro environment is just as vital as researching individual stocks.
Absolutely. Which is why I want to integrate our second major takeaway for you today. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store.
Put that macro gauge right on your home screen.
Yes, when the market gets euphoric, that app will remind you of the mathematical reality. Now, before we sign off, I want to issue a specific challenge to you, the listener.
Ooh, a challenge.
As soon as this deep dive ends, go to deepvalues.ai, open up the platform, type in the ticker symbol of a stock you currently own, maybe your biggest holding, and look at the current price versus its calculated intrinsic value.
Trace the math. Look at what the insiders are doing.
Exactly, that feeling you get when you finally see all the data laid out transparently. That is the feeling of the information gap closing.
It is incredibly empowering, but it also leaves us with a provocative thought experiment, one that wasn't explicitly outlined in the documents, but is the logical conclusion of this entire movement.
Let's hear it.
If artificial intelligence successfully democratizes this level of financial analysis globally,
Yeah.
if millions of everyday retail investors suddenly possess the exact same analytical firepower, the exact same SEC insights, and the exact same intrinsic value calculations as a Wall Street research desk that costs $50,000 a year to run,
Then what happens?
how will institutional hedge funds have to adapt?
Uh-huh.
How do they maintain their edge in a market where they can no longer rely on the structural ignorance of the retail investor?
Wow. What happens to the casino when they realize every single person sitting at the poker table knows exactly how to count cards?
The entire business model of Wall Street will have to evolve.
That is something to chew on. As the sources beautifully summarize, Wall Street works for Wall Street, Deep Values works for you. Thank you for joining us on this deep dive. Stay curious, stay informed, and we'll see you next time.